Welcome to this audio summary of Smart Money, How High-Stakes Financial Innovation is Reshaping Our World for the Better by Andrew Palmer. In this series, you'll discover how the very tools many people blame for the 2008 crisis can, when designed and used wisely, help tackle some of the biggest challenges of our time, from funding medical breakthroughs and securing retirement, to supporting startups, reducing poverty, and stabilizing the financial system. We'll walk through the story of money as a driver of human progress, explore how innovation sometimes turns into crisis, and then see how smarter design, better data, and new models of risk-sharing can turn finance back into a force for good in people's everyday lives. If you find this content valuable and want more audio breakdowns of powerful books like this, make sure you follow or subscribe to the show so you don't miss upcoming episodes. Please also take a moment to like or rate this episode on your listening platform. It really helps others discover the series, and share it with friends or colleagues who are interested in finance, economics, or making sense of how money shapes our world. Introduction. After the 2008 financial crisis and the severe recession that followed, much of the anger and blame focused on the financial system. Without the securitization of subprime mortgages, the collapse of the housing market would not have rippled through the global economy in the same devastating way. New financial instruments allowed a local problem to grow into a worldwide disaster. In Smart Money, Andrew Palmer argues that financial innovation can be a force for good rather than a source of harm, driving social change and giving people tools to improve their lives. Technological advances and big data can help experts make better decisions and design smarter financial products. Handmade to history. In the wake of the 2008 meltdown, many critics blamed decades of financial innovation for the crash. They argued that complex new products hid crucial information and that the world would be better off returning to a simpler era of basic deposits, mortgages, and straightforward banking. But turning back the clock is neither realistic nor desirable. From humanity's earliest days, financial innovation has supported the growth of civilization. As far back as 900 BC, traders used livestock as payment, and by around 400 BC in ancient Mesopotamia, people were carving early financial contracts into clay tablets. Loan repayments and livestock helped create the idea of interest. A lender who handed over 20 sheep could expect lambs in return within a year as compensation for taking risk. By the 9th century, China had introduced paper money, an early form of fiat money, currency with no intrinsic physical value but an agreed-upon worth. Debt, despite its bad reputation, was a crucial invention. It allowed money to move between savers and investors through what economists call intertemporal exchange. Lenders swap their financial capital today for borrowers' human capital or their ability to earn in the future. In that sense, a loan is a form of financial time travel. While debt offers a fixed return in the form of interest, equity offers the possibility of higher rewards, but the cost of higher risk. To control that risk, investors learn to diversify, spreading their stakes across many ventures so that diversification acts like a kind of insurance. The world's earliest known insurance contract dates from 1298, when a merchant effectively created the first derivative, a financial instrument whose value depends on an underlying asset. Derivatives led to the development of options, which give their owners the right, but not the obligation, to buy or sell the underlying asset in the future. The recent surge in financial innovation did contribute to painful economic setbacks, but over the long sweep of history, financial innovation has been a key driver of modern society. Three major forces, human needs, theoretical insights, and technological advances, have pushed this innovation forward and continue to shape the financial system today. From breakthrough to meltdown. The book's central claim is that financial innovation is essential for tackling the world's biggest problems. Over time, it has spurred economic growth, but it has also triggered repeated crises, with dozens of meltdowns in the last 2 centuries. Often, a new idea starts as a constructive solution, yet as it becomes standardized and scaled up, it can sour. Once financial products become popular, people begin to rely on shortcuts that can distort the original intent of the innovation. Market benchmarks, such as the Dow Jones Industrial Average and the S&P 500, give standardized views of the stock market's health. The International Swaps and Derivatives Association standardizes the legal terms for derivatives contracts, while LIBOR, the London Interbank Offered Rate, provides a common reference interest rate. These standards are useful, but they tempt investors, especially inexperienced ones, to lean on rules of thumb instead of examining each investment properly. Leading up to the subprime mortgage crisis, lenders and investors relied heavily on FICO credit scores as a single measure of borrower risk. Borrowers with scores below 620 were treated as clearly riskier, so lenders focused documentation requirements around that threshold. Borrowers just above 620 received roughly twice as many low documentation loans as those below it. Unsurprisingly, low documentation borrowers just over the cutoff defaulted at higher rates than those just under it. Competition and the rapid pace of innovation can also increase risk. High-frequency trading, or HFT, which grew rapidly in the 2000s, exploits tiny delays between the moment an order is placed and the moment it is executed. High-frequency traders use algorithms to buy and sell in fractions of a second. And to achieve these speeds, some code is simplified too aggressively. On May 6, 2010, this contributed to a dramatic flash crash, during which the Dow Jones Index and several individual stocks plunged and then recovered within about half an hour. That particular crash caused limited damage, but exposed the potential for more serious disruptions in the future. The most dangerous asset in the world. The 2008 crisis was global. Many of the hardest-hit countries had less sophisticated financial systems than the United States, yet their economies suffered just as badly. The common factor was an overinflated property sector and a widespread belief that real estate prices would always rise. The humble mortgage, one of the simplest financial instruments, pushed many nations to the brink of disaster. The world relies heavily on property because it makes up a large share of economic output. In most developed countries, real estate is by far the biggest component of national wealth. Yet as a financial instrument, property can be extremely dangerous. It is usually financed with heavy debt. While stocks and bonds might be leveraged at around 50%, property is often leveraged at 90% or more. At that level, even a modest drop in prices can wipe out homeowners' equity, leaving investors with no real assets. When such a leveraged and overvalued asset dominates an economy, the likelihood of a crash rises with every new dollar invested. Property is also vulnerable to human behavioral flaws. It is both a service, providing housing, and an investment, so the usual rule that higher prices dampen demand does not always apply. Buying a home is emotional, and emotions can overpower rational judgment. Rapidly rising prices encourage the availability heuristic, where people assume recent price jumps represent the true long-term value. The money illusion causes people to fixate on nominal prices rather than inflation-adjusted, real values. In theory, financial professionals should be immune to these biases, but bankers are just as human as everyone else. Because mortgages are backed by physical property, lenders classify them as secured and assume relatively low losses even in default. However, when properties are over-leveraged and prices fall sharply, that security can quickly evaporate. Some financial innovations aim to correct these weaknesses. In the United Kingdom, Castle Trust offers a partnership mortgage in which lender and borrower share both risks and rewards. The private equity firm Blackstone has created single-family rental bonds to channel investment into rental housing rather than simply inflating home prices. Social impact bonds and the shrinking of the state. Financial innovation is not just about gaming the stock market or enriching insiders. In recent years, philanthropically minded entrepreneurs have developed social impact bonds, or SIBs, to fund social programs that governments cannot fully support. In this model, private investors put up the money for a program, such as reducing repeat offending among ex-prisoners, and if the program meets agreed targets, the government repays investors out of the savings it achieves. When this works well, everyone wins. Vulnerable people receive needed services, governments save money, and investors earn a return. This form of impact investing, which aims for both financial and social returns, is closely associated with Sir Ronald Cohen, a British businessman. One of his landmark projects in Peterborough, England, involved funding 17 social programs designed to help prisoners leaving Peterborough Prison avoid reoffending. If these programs hit their goals, investors can earn returns of up to about 13.5%, lower than some high-risk investments, but accompanied by the satisfaction of contributing to social good. Early results have shown meaningful drops in recidivism compared with a control group, putting investors on track for a payout. Rigorous data collection and evaluation have been critical to this success, and similar projects in places like New York also rely heavily on careful measurement. By using market mechanisms, social impact bonds align the incentives of government agencies that commission services, social organizations that deliver them, and investors who provide capital. Rather than replacing the state, these structures aim to make public spending more effective and outcome-focused. Live long and prosper. Financial innovation can also help people live longer and better lives. At MIT Sloan School of Management, Andrew Lo and Robert Merton are working on ways to use finance to tackle major social challenges. Many potentially life-saving drugs stall in the valley of death, the risky and expensive translational phase between early research and clinical trials. Because this stage is so uncertain, investors are wary, and promising treatments often fail for lack of funding. Lowe's ambition is to cure cancer with finance by creating a massive mega-fund worth billions of dollars to back early-stage drug development. To make this attractive to investors, he uses securitization and diversification, techniques criticized after the financial crisis, but powerful when applied responsibly. By spreading investment across a large portfolio of drug projects, the mega fund increases the chance that some will succeed and provide returns. A third party, such as a charitable foundation, might partially guarantee returns, encouraging cautious investors to participate. While Lowe focuses on extending life, Merton focuses on securing a decent standard of living in retirement. As the baby boomer generation ages and people live longer than ever, both public and private pension systems face serious pressure. Traditional defined benefit plans, which promised a specific pension, are giving way to defined contribution plans that offer no guarantee of adequacy. Merton's SmartNest platform helps workers plan for retirement with the goal of maintaining their living standard. The aim is for retirees to purchase an annuity that delivers income similar to what they earned while working. If current contributions fall short, SmartNest clarifies the options: save more, work longer, or invest in riskier assets in the hope of higher returns. Equity and the license to dream. Supporting the young, both young firms and young people, is vital for economic growth. Startups that are not yet generating stable revenue are usually not in a position to take on traditional debt. For such entrepreneurs, equity is often the answer. They sell shares in their company in exchange for cash, preserving day-to-day cash flow while giving investors a stake in any future success. For investors, the risk is high, but so is the potential payoff if the company becomes the next big success story. However, this system suffers from a serious information gap. Venture capitalists exist, in theory, to bridge that gap by performing intense due diligence and backing founders they know well. In practice, this approach leaves many entrepreneurs outside mainstream networks with little access to funding, and the overall performance of venture capital is less impressive than its reputation suggests. As an asset class, it has often returned less than the total capital invested. Equity crowdfunding offers another path. Online platforms connect entrepreneurs directly with investors, bypassing traditional venture capital middlemen. In the United Kingdom, companies like Crowdcube and Seedrs are leading this movement. Critics argue that backing ventures rejected by smart money is risky, but traditional active investors do not have a flawless track record either. Actively managed funds often underperform simple passive index funds, especially after accounting for fees. For young people, the traditional way to fund education has been debt, especially student loans. Student debt has reached record levels, and many observers argue that burdening young adults with large loans before their careers even begin is dangerous. In theory, an equity-style investment in education could better align incentives, giving backers a direct stake in a student's future income, while lenders collecting interest on a loan care only up to a point about earnings. In practice, though, markets for education equity are full of uncertainty and regulatory questions. Companies like Lumni have pioneered human capital contracts as a possible solution. Under these income share agreements, investors contribute to a fund that pays for students' education. In return, students commit to pay a fixed percentage of their income for a set number of years after graduation, often around a decade. Although regulatory barriers have slowed widespread adoption, growing concern over student debt is pushing policymakers and innovators to take these models more seriously, and their role is likely to expand. Peer-to-peer lending and the flaws of finance. Anyone who has used a credit card can see the huge gap between the high interest rates charged on card balances and the relatively low rates paid on bank deposits. That spread has helped spark the rise of peer-to-peer lending, which uses digital technology to link borrowers and lenders directly, cutting out the bank. Traditional banks carry heavy overhead costs from branches, old IT systems, and large staffs. Peer-to-peer platforms operate much more leanly and, by removing the middleman, can offer borrowers lower rates while delivering higher returns to savers. The peer-to-peer idea has quickly expanded. Entrepreneurs now apply similar models to consumer credit, student loans, equity crowdfunding, and even certain types of insurance. Some observers dismiss peer-to-peer lending as a short-lived response to the financial crisis, but the growing involvement of institutional investors suggests it is more than a passing fad. As the sector evolves, many prefer terms like direct lending or marketplace lending instead of peer-to-peer. Regulators tend to view marketplace lending favorably because it avoids two classic weaknesses of banking: liquidity risk and equity risk. Banks fund long-term loans like mortgages with short-term borrowing. If those short-term lenders suddenly demand their money back, a bank can run out of cash. Marketplace lenders, by contrast, do not hold loans on their own balance sheets. When a borrower defaults, the investor, not the platform, takes the loss. Direct lending also sidesteps maturity transformation, where banks rely on depositors leaving their money in place to maintain equity. Without these mismatches, marketplace lenders face less systemic risk. These platforms also win on speed and convenience. For example, many small and medium-sized businesses complete marketplace loan applications outside of traditional business hours, often after starting and then abandoning a bank loan application. The main reason for abandoning the bank process is that it takes too long, making the faster direct lending option more appealing. The edge, reaching the marginal borrower. One of the most promising areas for financial innovation is serving people who are unbanked or underbanked. Unbanked individuals have no checking or savings accounts and live with constant financial uncertainty. Underbanked individuals may have some access to banking services but rely heavily on alternative providers. In many countries, a significant share of households falls into one of these categories, turning to services like payday lenders and pawn shops. Payday lenders offer very short-term, unsecured loans based on a borrower's next paycheck. Because they lend to low-income, higher-risk customers, they charge extremely high interest rates. What begins as a short-term fix can easily become a long-term debt problem. Many payday borrowers remain in debt for most of the year. While some payday lenders are blatantly predatory, others fill a gap left by the traditional banking system by providing quick access to small amounts of cash. Their rates are high in part because they must cover not only operating costs but also substantial credit risk. Some innovators believe better data can change this picture. Companies like Zest Finance use thousands of data points drawn from internet behavior and public records to build more accurate risk models of borrowers. With a clearer understanding of risk, lenders can set interest rates that more closely match each borrower's true likelihood of default, reducing costs for many low-risk but underserved customers. Other financial products focus on helping low-income households achieve more stability. Prepaid cards allow people to load cash and then use the card like a credit or debit card, giving them access to electronic payments without a traditional bank account. In many parts of the world, microfinance institutions provide small loans to poor entrepreneurs, helping them start or expand tiny businesses. After the tightening of credit that followed the last financial crisis, such tools have become even more important for people on the edge of the financial system. There are also initiatives designed to help people build savings and pay down debt. Rotating savings and credit associations, or ROSCAs, encourage savings by forming groups whose members contribute regularly to a shared pot. Each period, one member receives the full amount. Digital services like Ready for Zero show people their total debt in one place and offer guidance and reward for paying it off. Tail risk, pricing the probability of meltdown. Insurance companies and their reinsurers depend on careful modeling to understand and manage risk. When a catastrophe occurs, losses cascade down a sort of tower. At the top, policyholders bear some losses through deductibles or uncovered costs. Next, insurers absorb additional losses when they pay claims. To limit their own exposure, insurers pass some of that risk to reinsurers. But after a major disaster, the total damage may exceed even the reinsurer's capacity. At that point, the remaining risk must be transferred to the deepest pool of money available, the capital markets. One way to do this is with catastrophe bonds or cat bonds. Investors buy these bonds, which usually mature in 3 to 5 years. If no qualifying catastrophe occurs during that period, they receive their principal back plus interest. If a specified disaster does occur, and insurers must pay out large claims, some or all of the investor's principal is used to cover those losses. The cat bond market is still relatively young, but it shows strong potential, largely because of the sophisticated risk modeling it relies on. These models look not only at past events, but also at a wide range of possible future scenarios. The same techniques can be applied to natural disasters, pandemics, and even systemic financial risks. If similar tail risk modeling had been applied rigorously to the mortgage market before the subprime crisis, it might have revealed how dangerous certain securities had become and perhaps helped avert the worst of the meltdown. Would you like this turned into a more conversational narration script with cues for pauses and emphasis?